The FUELCEL energy stock has been the topic of many conversations as of late, and in this video we're going to look at its price actions, the recent developments, and the technicals and my opinion on if you should be buying the stock. As the market is very volatile at the moment, we would be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. FUELCEL has been having a relatively peaceful run lately, after the stock price fell along with the majority of the tech stocks despite the fact that it is in the energy sector and has been operating for a long time. It's worth mentioning that FUELCEL has been rather interesting as far as its recent history goes. Investors initially wanted to have a piece of it because they thought that it operates within the hydrogen fuel cell technology field. And back in the heydays of 2020, as soon as the company's profile contains keywords such as alternative energy, fuel cell, or electric, there will be droves of retail investors wanting to put their money in the stock. Obviously, that time is now long gone, and people have since then realized that FUELCEL operates in the natural gas sector, and that its profitability may not have been as stellar as many would have imagined if they've bothered to look at the financial statements at all. But nevertheless, it seems like FUELCEL has fell on a relatively low level, and that its baseline since 2020 has been higher compared to how things were previously. It's worth mentioning that FUELCEL has been able to outperform many other companies in the same field, which is in by itself a reassuring sign in this era of instability and uncertainty. Now, let's also take a look at the technicals of the stock. The trading volume of FUELCEL Energy has recently been 14 million shares compared to an average volume of 16 million shares. Over the previous 52-week period, its price fluctuated between $2.87 and $11.63. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activity and momentum for the stock. It often gives you a first idea about the popularity of the company, and when we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse or break through the current trend or resistance levels. Even when the current volume is lower than the average, it's still a good indication because it may signify that a trend reversal could happen soon. The market cap of FUELCEL Energy is currently at $1.3 billion versus an enterprise value of $1.2 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors. Whereas the enterprise value is usually the cost the company has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, which means that they're not items, equipments, or inventory that a company can use for generating income, but rather they're the promises that this company can grow significantly in the future, such as major contract pledges, the competency of the management, and schematics for new products. For startups, most of their valuation, if not all of their valuation, has been based on these intangibles, which may be valued in more favorable market terms. Basically, what this means is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, and it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that it deflated back to the reality ever since. As we compare the current price to the historical price fluctuations, the stock is 9.8% higher than the 1-month low, 21% higher than the 3-month low, and 21% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 101% versus a historical volatility of 107%. The put-call volume ratio is currently at 0.67. It is normal for many stocks to tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 17,000 contracts a day versus the 30-day average of 18,000. In terms of open interest, the most recent volume of open interest has been 237,000 contracts versus a 30-day average of 225,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Selling the contract would yield you premiums with an obligation to execute the contract if the counterparty chooses to do so as well. It's often said that you can evaluate the likelihood of the scenario based on the opposite of what the actual ratio is. For example, if there's a lot of put options, then there may be a possible uptrend on the move, or that a reversal may happen if there's a lot of call options. The reasoning behind this is quite simple. Most people trading options would see their options expiring worthless. In terms of its shareholder structure, about 40% of the FUELCELL shares are owned by institutional shareholders. The biggest shareholders include Vanguard, iShares, and State Street. It's relevant to understand the shareholder composition of a company, as this can help to determine if you would hold the stock long-term or to trade it short-term. If the stock is mainly held by retail traders, this could be a sign that the stock lacks the depth to justify long-term holding. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, since many titles are mostly held by retail investors and not institutional investors. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 16% of the total volume, and 30% of this coming out of the dark pools. So typically, if there's a short interest above 15%, that a significant chunk of it happened outside of public exchanges, this can suggest that there are institutional positions taken from the dark pools or in the OTC market to short the stock, and there would be potentials for a short squeeze. In the case of FUELCELL, I would say that the short interest is very significant. However, it's still too soon to say whether there is potential for the short squeeze. Usually, I would wait till at least 20% to start thinking in that way. My recommendation is to keep a position in FUELCELL because of its price level, no matter how small the position may be, and then to make sure the dollar cost averaging down in the next 6 to 12 months. I would recommend to commit between 0.5 and 1% of your portfolio's capital in the stock, and would also recommend to split the allocation in batches of 10 to 20% at a time, so that you can purchase more in further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.